The cost of house purchase, Module 5, the components of a mortgage. There are 4 main components to a mortgage: the principal, interest, taxes, and insurance. This is often referred to as PITI. In this section, we'll go over the principal and the interest. The interest rate that you pay on a mortgage goes to the lender in exchange for borrowing the money for the home. The riskier the mortgage lender perceives you to be as a borrower, the higher your interest rate will be. The main factors that influence their decision are your credit score and loan-to-value ratio. Loan-to-value ratio is the percentage of a home's value that you are being lent. For example, if you are buying a $300,000 home with a 7% down payment, you would be putting $21,000 down on the home. This means that your mortgage amount is $279,000, or 93% of the home's price or value. Therefore, your loan-to-value ratio is 93%. Generally, the higher the ratio is, the higher your interest rate will be. The principal is the money that you originally borrow when you take out a loan for your home. For example, let's use the same scenario of buying a $300,000 home with a 7% down payment. Subtract the down payment from the price of the home, and the remaining amount is your principal balance. So $300,000 minus $21,000 equals $279,000. Overall, the principal is the most important number to pay attention to when deciding how much you can afford to spend on a home. The percentage of interest that you pay on your loan per year is called an annual percentage rate, or APR. The average APR for first-time home buyers is 6.25%. So if you have a 6.25% APR on a $300,000 home, you would be spending $18,750 on interest each year. Now, let's look at an example of an amortization schedule. As stated in the last section, you will need to know your loan amount, interest rate, and the length of your loan. In this case, we'll use the same numbers as we have for previous examples. So, it's a $300,000 home with a 7% down payment and a 6.25% interest rate. This is a 30-year loan. Since we have paid 7% of the home's price, our principal amount is $279,000. Most mortgage payments are paid monthly, which means that you will have 360 total payments towards the loan. Each loan payment will be $1,717.85, with part of it going to the principal of the loan and the rest towards the interest. As you may notice, the majority of your loan payment go toward interest in the beginning. As your interest balance lowers with time, more of your payment will begin to go towards the principal amount. Now, let's look at the same loan for a 15-year period instead of 30. In this case, your monthly payment would be much higher due to the shortened amount of time to pay off the loan. It would be $2,392.21 for the 180 months. As you can see, it is very important to pay attention to the difference that your loan length has on your monthly payment. In conclusion, there are 4 main components of a mortgage: the principal, interest, taxes, and insurance. The principal is the amount that you have loaned to you for the home, while the interest are the charges for being lent the money. Your amortization schedule helps you see the payments across the life of your loan.